Are low rates keeping Canadians stuck in their homes? We're seeing multiple reports come out right now suggesting that Canadians feel stuck with their low rate mortgages because they feel like if they sell their property and move up, they're going to pay a high interest rate and it's going to be unattainable. And if they refinance, they won't be able to keep the same interest rates, which again will affect their interest rate and their payments. This is leading to this interesting conundrum where people are feeling stuck and can't move on. So today we're going to discuss specifically what this means, what your potential options are, and what the solutions could be long term. My name is Alex McFadden, and I'm here today with my mortgage pug Chewy to talk a little bit about things that impact your decisions as it pertains to your mortgage, real estate, and your long-term wealth. Let's get right into it, shall we? We've seen articles come out recently that are published saying Canadians feel stuck in their homes. Canadians can't move because of mortgage rates. Now, why is that happening? Well, ultimately that's happening because people had acquired mortgage rates that were exceptionally low, and now they're feeling trapped in their homes because they either can't port it, or B, porting it will cause them to increase their monthly payments altogether. Now, ultimately, in 2020 to 2022, we had unprecedented low interest rates. And most people in Canada either acquired a mortgage, so a brand new loan, or refinanced their loan during the years, specifically 2021 and the starting portion of 2022. A lot of these people locked into low fixed rate mortgages like 5-year terms. Now, many of these mortgage rates are as low as 1.5%, which today, looking at current interest rates around 6%, seems frankly crazy, but it actually happened. Fast forward to today in 2023, and we're seeing interest rates eclipse 5 and 6%, in some cases 7%, which is a large increase from 2022 and 2021. Now, what's happening is we've seen a large portion of people who purchased real estate or refinanced during those years coming out and suggesting, well, I actually want to upsize. My family is growing. A lot of people had kids during COVID, and they're looking to upgrade from a condo to a detached home, or a townhome to a detached home, or they're looking to relocate because of work. And what's happening in many circumstances is these people are looking at the possibility of taking their mortgage to where they're going, and either A, they're not able to do so, B, their bank doesn't offer a fair porting policy, or C, their mortgage doesn't go where they're hoping to go. What this is doing is essentially leaving people stuck. And in most situations, I'm finding, anecdotally speaking, that people actually just aren't researching their options. So let's talk a little bit about prepayment penalties and why people aren't breaking their loan, as well as the general guidelines in porting and how people are able to make the transition over to these new properties without feeling stuck. First and foremost, how different types of mortgage terms in Canada work are essentially you can choose a term of 1, 2, 3, 4, or 5 years. When you pick that term, your interest rate remains the same, assuming you choose a fixed interest rate mortgage for the life of that term. So for someone in 2021 looking into 2023, they still have 3 years remaining at this potential 1.5% to 2% fixed rate mortgage. And that's an extremely low interest rate. For example, if you're borrowing $100,000 at 2% today, your actual monthly payment can be less than $400. Whereas today, if you're taking that same interest rate at 6% over the same 30-year amortization, your payment is nearly $600. This is nearly a $1,000 increase if someone has borrowed $500,000 on their loan and they're switching from a 2% to a 6% mortgage, which has a pretty big impact when the average mortgage in many places of British Columbia and specifically the Lower Mainland have loans of $500,000 or more, especially for young families and first-time home buyers. What are their options? Well, first and foremost, many people can have the option to prepay their mortgage, which essentially means pay out the existing mortgage, pay the penalty, and start a new loan altogether. If you do this, the second consideration is that you have to qualify. If you can recall, since 2016, we've had the requirement to qualify on a stress test in one form or another, which basically means we have to take the rate that you're getting and add 2% to that and qualify on that higher interest rate payment. This not only reduces what people can qualify for, but of course restricts their ability to make that upsize move. In many circumstances in 2021, people were qualifying at a rate of 5.25%, and today they're qualifying at 7.5 to 8%, which has really impacted borrowing power by as much as 10 to 15%, depending on someone's personal situation. That's one reason that people aren't able to make the leap. The second one, as we mentioned before, is potential prepayment penalties. In many circumstances, people have taken loans where the prepayment penalties could be based on an interest rate differential or 3 months worth of interest, and in either case scenario can cost them thousands of dollars to exit their loan and move into that next property. Now, what this has left is with people looking at different options for porting. And the interesting thing about this is that porting is something that is different for every different lender and institution. As an example, some institutions allow a person to blend their mortgage with the existing term and the new term remaining. Now, this can get pretty complex. So as a basic rule of thumb, if you were to take a $250,000 mortgage with 3 years remaining and add a $250,000 mortgage on a new 3-year term, essentially the lender would take the existing term and blend with the exact same term that you had before to provide you with a blended interest rate, which is averaged between the two. That's a best case scenario. In many circumstances, lenders don't actually allow blending, which leads to a lender taking the existing mortgage portion, moving over to the new property and adding another component. Again, therefore reducing what someone can qualify for. What's even worse in many circumstances is that, well, that existing lender may not finance these different properties that you're looking to purchase, or you've changed your personal income situation, which has meant that you can no longer qualify for these different terms and rates. In either case scenario, porting is not always the solution. This is one of the big reasons we have a conversation like this upfront with our clients. So again, if it's not porting and it's not blending and it's not penalties that's causing people to feel stuck, then what is it? Realistically, it's the fear of the unknown. If there's anything I've learned in being in the mortgage space since 2011, most people assume something before they look into it. So even though payments may be higher, they make an assumption at how high they will be versus what they will actually be. As an example, in many cases, if I were to ask someone, if your rate was to go from 2% to 6%, how much more would your monthly payment increase? Most people would say my payment would increase 3 times, which is simply not the case. And so while many people can actually debt service or make and cover the payments of the increase of a mortgage interest rate increase, they just don't know, which means they don't take action, which means they never actually end up making the move. And that accounts for a large group of people, because the same thing occurs when it comes to buying real estate, believing myths like you need 20% down or that it's a good or a bad time to purchase real estate. Ultimately, the fear of the unknown is one of the #1 reasons that people don't make a move in this real estate market. In your current situation, the reality is you need to assess where you stand right now and what are your potential options. Typically speaking, when there's a fear in the marketplace, it's one of the best times to purchase. But you also don't want to purchase a property, lose out on existing monthly payment, only to put yourself in a situation where you cannot make your monthly payments or you're living paycheck to paycheck. I do believe that for many people in this current market, there's a fantastic opportunity to make the lateral move or make the upsize move or to buy the investment property at a time when simply most other people will not, and especially when real estate prices will continue to be deflated. But the flip side to that is that many people should not be making that type of move in this environment unless they have really, really good control of their existing budget, they have good cash flow, and they know exactly where they're going to be in their future. Ultimately, there's no easy solution for someone feeling stuck in their home, but the easy answer to all the above is to actually do the research yourself. Find out if you can port your mortgage, you can blend, find out what the actual cost will be to increase, and consider what the opportunity cost will be if you don't make that upsize move. Again, I'm Alex McFadden. If you found this video helpful, make sure to leave a comment below. Let me know by hitting the like button. Subscribe. Look forward to hearing from you soon.